Well, we just came off a huge jobs report. Stocks rallied to all-time highs once again. Um, and I've got a question. Actually, I got a few questions, but that's why we're
I
bringing in
bet you do.
that's why we're bringing in Jim Welsh from Macro Tides. He's coming in to answer all of these questions about the jobs report, what we make of everything, and what he's made of everything, and
Yeah.
where the market's going to go from here. So, Jim, welcome to the Trader
Post
Summit as
jobs
we bring it in
report
every
Friday.
Friday. So it's good to see you.
Good to see you too.
Well, tell us what I mean. What do we make of this jobs report? And let me
Yeah.
ask you this. Do we automatically shave 60, $70,000 off the headline number, or 70,000 jobs off the headline number? And I mean, are we closer to 200,000 jobs? I mean, is that how we have to look at things?
No, it was a good jobs report. And in Monday's weekly technical review, I went through the markets like you and I do, looking at the dollar, treasury yields, the S&P and gold. And my conclusion was the charts were indicating that the odds were that this jobs number would come in stronger than expected. We've had three in a row that were weaker than expected. The revisions were pretty significant in the last two, three jobs report. And today we saw the opposite. We had a really good top line number. The revisions, I think, were plus 71,000 for July and August to the upside, not the downside. Wage growth 0.4, so wages ticked a little bit higher. The one thing that is a little bit that doesn't necessarily jive with all that other data is the work week actually declined by a tenth. And when you're talking about 155 million workers, a decline of 1/10 doesn't sound like a whole lot, but you multiply it by that many workers, and it's not insignificant. So for me, it was like looking at the charts, looking at what recent history has been, and the idea, you know what, I think it's time for a better than expected number. And it was an educated guess that turned out to be right this time.
Well, we got that, and we obviously got stocks rallying to all-time highs. You know, it's been really interesting, and I can't wait to see your count on this today. Is
Yeah.
gold sold off barely? I mean, and we
Yeah, it
turned it
held
back.
in. Yeah,
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 turn and
yeah.
rallied back pretty aggressively. So gold looks like this insatiable bid. Hey, real quick before we get into the charts that you brought, I want to ask you this, Jim. How are you feeling about what's happening in the Middle East, and is that altering anything, any of your wave counts, or how you're approaching the market at this point?
Not really because it's an unknown. So I mean, I'm just trying to take most of the numbers based on what we see because that's all we really know. I think in terms of gold, I think that's one of the reasons why there's been a bid underneath gold because we've seen a decent rebound in the dollar index over the last 3, 4 days. And yet gold has been pretty resilient in the face of that. So I think that's to me the one market, obviously oil being the other market that has been benefiting regarding the prospect of losing oil production in the Middle East.
All right. Well, Jim, I guess what we can do is we can start off with the first chart you brought. So let's get to it. And that is the city economic surprise and the 30-year yield.
Index.
So what are you making of this, and why is this important to us?
Well, what I'm showing here is the City Economic Surprise Index, and we've talked about this, a number of times over the last 6 months, or longer, is that what happens is when data starts to come in below expectations, the future expectations get lowered, and conversely, when the data comes in better, they begin to raise future expectations. So this is like a contrary indicator in the sense of are they going to be surprised to the upside or disappointed to the downside? So what I'm trying to do is show how changes in the economic surprise index has then been reflected in the 30-year Treasury bond. To me, this is a really cool chart. So what we saw last September and October is the surprise index was at a fairly high level. Why? Because data kept coming in better than expected. Then all of a sudden we saw data come in, expectations got raised. Lo and behold, the index falls because the data comes in and doesn't meet those higher expectations. And look what happened to Treasury yields. The 30-year went from 5.15 down to whatever that small number is down there that I can't read without my glasses.
393, 3.9, 3.943.
Yeah, it's over 100 basis points. Pretty significant move. Then we saw a rebound in the surprise index. It kind of held up until we got into, I believe that was March, and then it started to come down. And lo and behold, we saw yields top in March, and then they started to come down. And from that peak, you can see at 480, whatever it is, and they worked their way lower. Then the surprise index kind of chopped sideways through most of August. And then as we approached the Fed meeting, yields kept working their way down, even as the surprise index started to tick its way up. But as it really kept going, and we got the yield, the cut in yields that the people were hoping for, yields have been going up ever since. And I did this chart yesterday, so it doesn't reflect what's happening today. So that's why it looks a little bit more muted. But the 30-year Treasury yield's up, I think, double digits in terms of yields. Certainly was at the opening. So the point being is, if the past is any guide, we'll see expectations and the surprise index continue to work its way higher. Things like today's employment report. Yesterday's ISM services number came in better than expected. So this surprise index is from a week ago. So it's going to start to keep going up. And the point being is, at some point in time, people are going to ratchet up their expectations for the future numbers. The index will be up somewhere between plus 20 and plus 40. And then it's set to see it roll over as data comes in less than expected. That would be my expectation. So I just think this is an interesting economic stat that I've never seen anybody overlay or compare to 30-year Treasury yields, but the relationship has been really pretty tight. Yields have been heading up.
Well, that begs the question in your next chart about rates and expectations. I mean, just today, after the jobs report, expectations of an aggressive rate cut coming in November has dropped obviously dramatically due to
Of course.
data. So how are you going to read this, and tell us about this chart?
Well, again, to me, we're at an inflection point in the economy. The Fed is really, truly data dependent. Therefore, they really don't know how the data is going to come in. They put out kind of a guesstimate in terms of how many cuts through the end of next year. Wall Street, of course, is, oh no, they're going to cut them even more. All right. So to me, the game is always, Blake, compare what Wall Street thinks with where the Fed is at, and then kind of figure out what's going to go from there. So my point being is, Wall Street was expecting that maybe the Fed will do another 50 before the end of the year. Well, that's not what was in the dot plot. Given where GDP's been hovering and everything else, in my view, it was completely unrealistic. So the fact that it's being dialed back today, it means like, okay, it shouldn't have been where it was yesterday. My only point in showing this is we're seeing, obviously, concerted effort by central banks all over the world. They now can cut rates. Inflation has come down. What's interesting, again, is that we're seeing rate cuts in this country, even though we have a 7% deficit of GDP. Government spending is, like off the charts. The economy's growing at 2.5% to maybe 3%. This is kind of unprecedented stuff. But this is supportive of equity markets historically. Again, when you see central banks cutting rates, they're also in some cases adding liquidity. That's a plus for equity markets. But Treasury yields may not react to that in a positive way. And that's why, over the last month or so, as we made that high 2 weeks ago, I've been talking about, from the low of October of last year, it's possible that you have completed the counter trend rally. Right. Okay. So anyway, But maybe we'll talk about that when we get into the charts.
We will, but I got to ask you, maybe that makes. I mean, I understand your argument, but maybe it makes sense why stocks gained aggressively following the jobs report, but after the market sat back and said, "Oh, we're not going to get as many rate cuts as possible," the stock market gave back all those gains pretty much immediately, even though we had
Yeah,
such a strong jobs report.
yeah. Again, you've mentioned a couple of times. I go by intraday highs and lows on the S&P, really all the markets. The S&P did not make a new all-time high this morning.
Yes,
All right,
that
it
is
fell
correct.
short. On a closing basis, it might have been, higher than the highest close we've seen. So again, you got a knee-jerk reaction, and then as you pointed out, we're seeing selling come in. The momentum indicators, I use things like look at highs and lows. Well, they've been contracting the spread between the number of stocks making new highs and lows. Upside volume has been contracting. So the warning signs that we're nearing an end, which is what I said last week. I think we're nearing the end of this rally in the S&P. You get data like this, you get the knee-jerk reaction. So we'll see how the market closes, and more importantly, we'll see how it trades early next week.
Okay. Well, the next chart before we start getting into some of the technicals, you did want to bring up this chart regarding
Yeah,
the jobs data. So let's talk about
yeah. I mean, again, if you look at the left-hand side, which is the monthly change in payroll, consistently as these numbers have been if you used a moving average, you can kind of see that the moving average has been trending lower. But you've gotten these pops along the way as you've been zigzagging your way down. I think this number is going to be one of those zigzags, 1 month strong number. I don't think we're going to see it repeated next month.
Okay.
So,
Well, but this
time will tell.
unemployment rate is also improving too. You can see it's
Yeah, it's coming down. And as I said in July, whenever it was in August, whenever, oh my God, the SOM rules indicated a recession. And I said, no, I think that's really an overreaction because part of the increase in the unemployment rate was because we had more workers coming in. There's a huge difference between the unemployment rate going up because supply of labor is increasing versus companies are laying people off.
sure.
And so, again, I think labor markets are going to ease more. I think we're going to see the unemployment rate tick higher, but I'm trying to take this 1 month at a time and be objective about what's happening and not overreact one way or the other. And that, so
Well,
far, I think that's worked out pretty well.
I'll tell you what's kind of overreacted this week is the dollar. This is your first chart, and the dollar has really
Yep.
stuck it to the bears this week.
Yeah.
So
Yeah.
what do you do
Well, when
here?
we talked last week, Blake, what I presented was this chart where, okay, you had a wave A up. Now, okay, from the high back at 105 or 106.52, 1, 2, 3, and we were in a wave four. The 101.92 was what I said last week is wave A of wave four. And then as the dollar kept working its way down, it was grinding, At the same time, look at the RSI at the bottom panel. So the dollar is making lower lows, but the RSI was making higher lows. There was compression being built up. And this is why in Monday's weekly technical review, to me, this is, one of the reasons why I thought the jobs were going to come in stronger because the dollar chart looked like it was going to rally above 101.92. And, it strengthened the last 2 days and then obviously got a bigger pop today on the jobs number and made it up to 102.65. My take is there may be a little bit more to upside on the dollar index, but I think the next move is going to be to the downside, Blake.
Well, well,
I think it's
that's
going
a
to go
that's a
to a lower low below 100. It's not going to happen next week, but I think that's what we're seeing bigger picture is that the next larger move will be to the downside to give us wave five of wave three. And so what will cause that? Well, data coming in at some point in time, 2 or 3 weeks from now, a little softer than expected would be one of the components. But let's take it. I mean, so far, so the analysis of the dollar index has really kind of followed the script pretty well. And, again, I think the patterns for me is clear. We were going to get a bounce. Then I think we're going to see another leg down.
All right. Well, we'll see. We'll see about that. I know next week's inflation week, and I don't know if that we have many days ahead of all that, going into next week. But I guess
Yeah.
we'll have to take it one day at a time. So
There
this
was
is
no other choice, guy.
right.
Okay. So,
Gold.
as you noted about gold, I keep talking about, as I mentioned before when you asked, Middle East, I think is helping be a prop. There's from where I have wave 5 from that 2684, what's happened is not so far an impulsive move to the downside. The 5-day red moving average is still above the green, so, I think there's a turn lower coming, but it's not really been confirmed or signaled yet. So can you see one more pop above 2684? Yes. Again, my take is we're finishing the rally from 1812, and that will lead to a wave 4 correction, and then we'll see wave 5 taking gold to a higher high. So, obviously it's overbought. If gold should make it to a higher high, Blake, you can kind of tell by the RSI on gold at the bottom panel there that if it makes a margin to new high, the RSI won't confirm it. So maybe that's what we need to see is one more pop, divergence on the RSI before we really get the price reversal.
Got it. All right. Well, the next chart you brought, Jim, is the S&P, no, TLT, I'm sorry.
Yeah.
So here's TLT and then S&P afterwards. So
yeah.
What do you make of this? Because bonds are actually falling pretty aggressively. Yields are going up.
Yeah. Well, that's been my take. I thought that we would see a window of time where we would, that the pattern, when it got up above 100, that we're nearing the end of this rally. You can see in the bottom panel, the RSI diverged where it made a lower high, even as TLT was making a higher high. It was just over a 4-point drop from 104.64 to 97. The equality of A and C would be 95.11. The 382 of the move from the low at 87 up to 101 is 86. So my take here, Blake, is that this is a time to be buying TLT. And my subscribers have a third position at 90, just over 97, I think 97.40 or 50. And then another third position at the opening this morning, which was pretty much near the low at 95.40. So again, my bias is the jobs number. I thought it would come in stronger, but I don't think that's going to be the trend in coming months. In fact, I think it's going to be, that we're going to see more slowing. That proves correct. TLT, after this pullback is complete, I think a rally to 105, 109 is coming. And that's why I've suggested buy on weakness.
All right. Well, let's see if I get a little nervous as things are dropping so quickly, but if this is fitting in your narrative, it is, and that's the way. It's the way you're seeing it. All right.
So far.
Yeah, I know it's always nerve-wracking trying to do that. Catching a falling knife, if you will. So
yeah.
Here's the S&P. Speaking of
okay.
one way train.
Yeah. Well, the target range was 57.25 to 57.43. The S&P beat it so far by 24 points, which is less than about 0.5%. As it was making higher highs a week ago, you can see the RSI was making a lower high. That suggests to me that upside momentum is obviously waning.
Yeah.
The key is 56.74. That's the recent intraday low, I think 3 days ago. So it closed below that. would be, to me, like a signal that, okay, we're about to have a correction. You can see the 5-day exponential in red versus the green is starting to narrow. And if the S&P closed below 56.74, the 5-day probably would trade and cross below it. So the table is set in my mind to see a pullback. The first target becomes those most recent lows in early September, just above 5,400. And if the semiconductors weaken, which is the next chart, we talked about it last week. I think you even, kind of the headline on our interview last week was "Watch the Semiconductors," which I think was appropriate. So in July, you can see the semiconductors. This is the SMH ETF, which mirrors the semiconductor index, made a higher high, but look at the RSI, diverged rather badly. The stocks, semiconductors then dropped over 20% very quickly. Since then, they've had an up, down, up rally, which looks 3 waves. That's counter trend rally. They gapped open on this morning, and they've been fading ever since. So what that implies to me, Blake, is that they're set for another leg lower. And, the most recent lows at 200, 213, are the first targets. If wave A and C, or this next leg is equal to the first leg, you're talking 275, pardon me, 175 on the semis. But at a minimum, to me, this looks like a test of 213 is coming. If that happens, I think the S&P obviously is going to be weaker than 5,400.
Sure. All right, Jim. Well, that's a lot you put together for us this week. I definitely like the setups. I'm not sure I'm completely sold on the idea that that the S&P is ready to come down. I think the proof has to be in the pudding, but you can see, as you pointed out, those moving averages are really starting to tighten up around here.
Yeah, so. Yeah. I mean, again, underneath the surface, momentum has been waning. All you need is a reason to sell to create the price weakness. And like yesterday, Jensen Huang from NVIDIA, was talking about the demand camp. Oh my God, it's extraordinary, blah, 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 blah. And yet, NVIDIA is still in a downtrend in terms of its stock. So institutions were overweight technology, the artificial intelligence stocks, and semiconductors in particular. When they decide to go from being overweight to equal weight, they have to do selling over a period of time. And to me, that's what we're kind of been seeing, is selling into strength. And technically, the pattern in the semiconductor, unless it can get above that most recent high, which I think was 255 and change, the pattern to me as it stands today looks weaker. And that suggests lower prices. And if the semis go down, they're going to pull the S&P down just because of the exposure in the weighting that they have in the S&P.
Sure. Well, Jim, let us know as traders how we can follow you. Before you do that, you see that little subscribe button down there. Make sure you subscribe to this channel. It is free to subscribe, but this way you won't miss any of these interviews that are exclusive here on Trader Summit. So, Jim, what's the best way, aside from here, what's the way they can follow you on a daily basis?
Macrotides.com, Jim Welsh Macro at Gmail. If you want something, I'll send you the most recent report, and you can kind of see. I mean, you and I kind of cover things in a fair amount of detail. I go into even more detail. And, I like to think that some of the pieces are an educational tool for people who are trying to learn about the markets and how to integrate fundamental analysis with technical analysis. And this week was kind of an interesting proof of that, is that the charts indicated to me that the odds were we're going to see a stronger jobs report. Now, as you know, I think the labor market's going to continue to weaken. But the charts indicated, what, we're ready for an upside surprise. And, Murphy once in a while takes a day off.
Yeah, right, exactly. And so does gravity, apparently, in the market. So, Jim, I want to thank you for being with us this week. And I always look forward to catching up with you on Friday. I know a lot of people actually rely on your Saturday morning videos to drink coffee and get really in tune for the next week. So, on behalf of all of our loyal viewers, thank you all for being here. Make sure you give Jim a big
Yeah.
thumbs up and tell him how much you appreciate him every week. All right. Well, thank you, Jim.
Thank you, Blake. Have a great weekend.
You too. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.